On the evening of August 15, 2023, more than 400 Singaporean police officers launched coordinated raids on 9 of the most luxurious apartments in the city. It was a major operation. One suspect still attempted to escape, jumping onto a second-floor balcony and dislocating his wrist and ankle. He hid in a drainage system, but was eventually found. 10 suspects were arrested. Assets including luxury cars, artworks, cryptocurrency holdings, watches, designer handbags, and cash worth more than $1 billion in total were seized. In fact, there were 27 suspects altogether, but only 10 were captured in this round, while 17 others remain on the run. Afterward, investigators discovered that the total amount of illicit money exceeded $3 billion, mainly originating from an illegal online gambling platform operating in Southeast Asia, along with various illegal lending activities and online fraud schemes. Ultimately, the case was exposed when the criminal network attempted to launder money in Singapore. This became the money laundering scandal that shocked the world and the largest case in Singapore's history. We have thoroughly investigated this case and how dirty money was laundered. But the story doesn't end here. Stay with us on Mr. Explained Man in today's video. According to preliminary United Nations estimates, the scale of global money laundering accounts for roughly 2% to 5% of global GDP each year, equivalent to more than $2 trillion. Around us, countless ordinary economic activities across every industry, even routine deposits and bank transfers, could be concealing money laundering operations. I have studied hundreds of money laundering methods and hundreds of classic cases to answer the question, what is money laundering? First, I must emphasize that money laundering is illegal. You are not allowed to launder money. This video is only intended to help people understand money laundering more clearly, so they can better prevent it and better understand how the world works. Simply put, money laundering is the process of legalizing illegal money earned by criminals so it can be spent openly. Some people may ask, why not just spend stolen money directly? If you only have a few $1,000s, you can probably spend it freely. But what if you have a few million or a few $100 million? It's like an 8-year-old kid finding $100,000. If he went home and bought a brand new car, it would immediately raise suspicion. That's why money laundering is the way criminals spend this money legally without being questioned. When the amount of stolen money is massive, money laundering becomes essential. Criminals have to solve two problems. First, covering their tracks, and second, making their income appear legitimate. To address these two problems, criminals use a wide range of laundering techniques, from opening restaurants and laundromats to running casinos or gold shops. These industries handle large volumes of cash, making it easy to blend dirty money into clean revenue streams. That's why money laundering is a method of both erasing traces and legitimizing illegal income. Back in the day, many mafia bosses and drug lords often ran legitimate businesses of their own. If they tried to launder dirty money directly, it was easy to get caught. But if they mixed it into clean money, the process became far easier and much more discreet. However, this method also has its limits. First, you need a real business. For example, if you own a restaurant but barely have any customers, you can't claim you're making $100,000 a day. The laundering throughput would be hard to achieve. And is a drug kingpin really going to run a laundromat every single day? That would be ridiculous. So as the amount of money that needs to be laundered grows larger and larger, this method is only seen as the starting point of a broader laundering chain. To reduce risk, criminals usually don't hold assets directly. Instead, they use shell companies or put assets under someone else's name. Another common method is laundering money through casinos. Criminals don't need to open their own casino. They can simply go there because casinos make it easy to legitimize income with unclear origins. They can exchange cash for chips, play a few hands just for show, then cash the chips back out. And if anyone asks, they can say, I hit the jackpot yesterday, $3 million. That said, major casinos today have much stricter rules. It's now difficult to conduct large cash transactions without having to verify where the money came from. Next are laundering techniques that involve converting money between different types of assets, making it much harder for regulators to track. The first method is through art. At art auctions, both sides of the transaction are often kept confidential, and cash payments may be accepted, making it extremely convenient for money laundering. The value of art can also fluctuate wildly, from $10,000 to hundreds of millions of dollars, allowing criminals to easily channel dirty money into it. In 2012, the Mexican government passed an anti-money laundering law that placed strict limits on cash transactions in the art sector. As a result, Mexico's booming art market cooled down immediately. This shows that the art market can be a common channel for money laundering. However, not every art transaction is tied to money laundering. One common tactic is to buy a low-priced piece of art, then hire an appraiser to inflate its value and sell it back to your own shell company. For example, you buy a painting for $100,000 and have it appraised at $10 million, instantly legitimizing the $9.9 million difference. Many people also use art as a tool for bribery. Instead of handing over cash, which is hard to spend discreetly, they give expensive artworks as gifts. It looks classy and stays under the radar. Beyond art, another asset criminals love using for money laundering is real estate. Compared to art, real estate has more stable value and is easier to invest in. And who doesn't like owning a luxury villa? In many cases, real estate is the final destination of the money flow. For instance, in the Singapore laundering case mentioned earlier, as many as 207 properties were involved. But real estate can also play other roles in the laundering process. The most direct one is simply absorbing cash. Some countries, like Dubai, allow people to buy property with large amounts of cash without investigating income sources or even identity. On top of that, real estate can create legal proof of where wealth came from. For example, someone can buy a house using money from a shell company, then sell the house, turning dirty money into legitimate income. You see, with amounts this massive, money launderers often use real estate without caring much about real market value. They're willing to push prices up without hesitation. This is actually one of the major reasons housing prices have skyrocketed in places like Dubai, Singapore, and Hong Kong. Another common asset conversion method is laundering money through gold. Gold has key advantages. It's easy to transport, easy to store, and much more liquid than art or real estate. Let me tell you a real-world example of how a money laundering gang in Morocco helped drug lords in the UK launder money. First, a UK drug boss stuffed hundreds of thousands of dollars in cash into the trunk of a car and arranged to meet a contact, A, at a public place like Starbucks. After verifying a password, A took the car keys and began the laundering journey. A, who on the surface was just an airport janitor, drove the cash from the UK to Paris and handed it over to B, an ambulance driver. Then B passed the cash to his brother C, who counted it and packaged it into bundles of $10,000. Everything was done with extreme care. After that, B delivered the money to two middle-aged women, D and E. They drove to Belgium to meet a black market gold dealer, exchanged the cash for gold, and received fake receipts. Carrying gold draws less attention than carrying cash, and even if customs finds it, it looks far less suspicious. D and E then flew from Belgium to Amsterdam, and from there to Dubai, where they converted the gold into clean money, deposited it into banks, and transferred it into anonymous accounts belonging to shell companies around the world. This entire operation was complex, secretive, and highly professional. The gang used this method for years and laundered $250 million. All of this complicated exchanging, buying, selling, and cross-border movement was mainly designed to exploit legal gaps between countries. Essentially, they took advantage of cross-border cash transport and repeated conversions between cash and gold to erase traces and make it extremely difficult for regulators to track. So how was this sophisticated method uncovered? Ironically, the very complexity of the transaction chain created a weakness. An auditor from Ernst & Young, while reviewing the accounts of a major jewelry company in Dubai called Coty, discovered unusually large cash purchases, amounting to more than 3 tons of gold per year. He reported it to the police, and the investigation eventually traced the entire laundering chain, arresting 25 of the gang's 27 members. 2 ringleaders have still not been captured. As mentioned earlier, criminals can launder money by converting cash into art, real estate, gold, and many other forms. Every conversion like this multiplies the difficulty of the investigation. Criminals try to remain anonymous, leaving as few traces as possible, sometimes even avoiding security cameras when transferring assets. Next comes the question: how do they legitimize the income? The methods can be highly diverse and customized. In theory, any investment, buying a consulting firm, a trading company, or a restaurant, can generate profits that appear clean. But when the real goal is laundering money, criminals often want quick gains. They don't care about actually building the business. They only want to maximize cash flow as fast as possible. Finally, I want to highlight what is probably the most common method today: laundering money through shell companies. A shell company is a company with no real business operations. Criminals often set up accounts in tax havens such as the British Virgin Islands, Bermuda, the Cayman Islands, and Panama. In these places, forming a shell company is extremely easy. It can take just a few minutes online without providing personal information. Opening a bank account can be more complicated, but criminals can hire intermediaries to handle it. For example, a Mexican criminal organization in the 1990s used shell companies to launder money. They deposited massive amounts of cash into a bank in Luxembourg under the name of Company A, then used the certificate of deposit as collateral to borrow money in Paris through Company B, and finally routed the funds onward to Company C in Panama. Investigating shell companies is extremely difficult because of bank secrecy rules. Every transaction passing through multiple countries, like Luxembourg or Panama, becomes complicated and time-consuming. You might ask, why not ban shell companies altogether? The truth is, shell companies are very useful in legitimate business transactions. For example, helping structure corporate governance or optimize taxes. The problem isn't the mechanism itself, but the way it is monitored. Under the banner of protecting privacy, some countries and territories, especially tax havens and small islands, have historically maintained weak anti-money laundering regulations, unintentionally obstructing investigations and attracting dirty money from everywhere. However, since 2017, they have been forced to comply with US and EU anti-money laundering rules. Do you notice what the key point is across all these laundering steps? It's exploiting differences in regulations between countries. If a shell company operates only within one country, the government can control it relatively easily. But once it crosses international borders, everything changes completely. Regulators can investigate deeper, but doing so requires enormous manpower and time. It becomes a game of cat and mouse, where the mouse is always trying to run farther and create more layers of anonymity. Another common method is for criminals to open multiple bank accounts under other people's names. These accounts require identity verification, but criminals can steal someone else's information. In some cases, the victims don't even know an account has been opened under their name. Many victims receive letters confirming that an account was opened, often because their personal information was exposed when they fell for a scam. For example, an elderly man was tricked out of $300,000 through a phone scam. That money would be moved through multiple accounts that were not under his name in order to buy time, and eventually transferred overseas. Once the money has been sent abroad, getting it back becomes extremely difficult. Beyond using stolen identities, criminals can also manipulate you into participating in money laundering without you realizing it. For instance, if you're an ordinary person, criminals may transfer money into your account and then ask you to send it back out, turning you into part of the laundering process. Without knowing it, you become their accomplice. If you look at money transfers through shell companies, you'll see that the strategy relies on national borders as barriers and uses privacy protections to erase traces. Meanwhile, the delayed deposit method exploits strangers' accounts to clean the money's origin. A more advanced version adds another layer. The participants themselves are separated. That means you send money to A, but B sends money back to you, creating additional layers of anonymity. In reality, A and B are working together, but on the surface, they may appear to have no connection at all. Of course, regulators are also continuously upgrading their surveillance technology. For example, Singapore has implemented AI-based detection methods to link payment systems and cross-check data in order to identify suspicious behaviors, such as why one device is logging into thousands of accounts at the same time, or why multiple devices and accounts are connected to the same Wi-Fi network. They try to uncover patterns hidden inside these complex data signals. Now, going back to the largest money laundering case in Singapore that we mentioned earlier. First, the criminals moved money through multiple shell companies around the world. Do you know how they got past Singapore's banking rules? The tactic was surprisingly simple. They forged documents, including asset certificates, property sale confirmations, and even employment verification, then submitted them as proof of wealth. Forged paperwork is a common trick, but in this case, those fake certificates were exactly what exposed them. In 2021, one bank discovered a forged asset certificate and launched an investigation, uncovering a $3 billion money laundering operation involving 27 people. In this case, 10 suspects were arrested, sentenced to 13 to 17 months in prison, and had 95% to 100% of their assets confiscated. From May to July 2025, they were released early for good behavior and deported from Singapore. The sentences only covered the money laundering offenses committed in Singapore and did not include crimes related to fraud or illegal gambling. The confiscated assets were auctioned off and transferred into Singapore's government funds. This case helped Singapore recover billions of dollars, but it caused serious damage to the country's reputation. As a result, Singapore quickly amended its anti-corruption and anti-money laundering laws, especially by tightening the asset verification process for wealthy foreigners. That made it more difficult and more complicated to move assets into Singapore. An interesting trend followed. Over the past 2 years, setting up family offices in Hong Kong has become increasingly popular, as some wealthy individuals chose to move assets from Singapore to Hong Kong. This brought a large inflow of capital into Hong Kong. Keep in mind, not everyone moving assets to Hong Kong is doing it to launder money. Many wealthy individuals choose Hong Kong and Singapore because they want capital to flow freely, efficiently, and quickly. But now that Singapore has added more layers of screening, some people have shifted to Hong Kong simply because they find it inconvenient. This helps explain why tax havens are often not highly cooperative when it comes to global anti-money laundering efforts. The global anti-money laundering system, especially in major financial hubs, is like a balloon that seems perfect, but even a tiny hole can cause it to collapse. One of the first principles in anti-money laundering is knowing your customer. Banks, especially in Europe and the United States, are very familiar with the term KYC, which requires understanding a customer's activities and intentions. But because money laundering methods evolve so quickly, banking rules struggle to keep up, so institutions often rely heavily on the subjective judgment of wealth managers. Still, we need to emphasize once again, money laundering is illegal. What's your view on this activity? Share your thoughts in the comments below. For now, goodbye, and I'll see you next time.